Chip stocks just wiped out $138 billion in a single day. Here's what it means for your portfolio. This massive market capitalization loss represents one of the most significant single-day declines in semiconductor sector history, signaling deeper concerns about technology valuations and growth expectations. Market context. The semiconductor industry experienced a historic sell-off that sent shockwaves through global equity markets. This decline reflects growing investor anxiety about chip demand, supply chain normalization, and the sustainability of elevated valuations in the tech sector. Key players affected. Major semiconductor companies including Nvidia, TSMC, AMD, and Intel all experienced substantial share price drops. These industry leaders, which have driven much of the market's recent gains, saw their valuations compressed as investors reassessed growth prospects and profitability timelines. Triggering factors. The sell-off was catalyzed by disappointing earnings guidance and weakening demand signals from major customers. Analyst downgrades and reduced revenue forecasts accelerated the sell-off as investors rushed to reposition their technology allocations. Contagion effect. The decline spread beyond chip manufacturers to impact the broader technology sector and related industries. Companies dependent on semiconductor supply chains and investors holding large tech positions felt immediate portfolio pressure from the cascade of selling. Analyst reaction. Market analysts responded with mixed commentary, with some viewing this as a necessary correction and others warning of further downside risk. Investment firms began adjusting price targets and sector recommendations as they incorporated new demand data into their models. Institutional response. Major institutional investors and fund managers faced difficult decisions about maintaining exposure to semiconductor stocks at lower valuations. Some used the decline as a buying opportunity, while others chose to reduce technology sector weightings in their portfolios. Valuation reassessment. The market had previously priced in aggressive growth assumptions for chip companies that now appear unrealistic. This repricing reflects investors' recalibration of earnings expectations and required rates of return for technology investments. Supply chain implications. The decline raises questions about the normalization of semiconductor supply chains that had been severely constrained. If demand truly is weakening, excess production capacity could pressurize pricing and margins across the industry. Geopolitical factors. Trade tensions and export restrictions affecting semiconductor sales to certain regions contributed to negative sentiment. Concerns about China's technology independence efforts and potential future restrictions added uncertainty to long-term growth projections. Consumer impact. This sector weakness could eventually benefit consumers through lower prices for electronics and computing devices. However, near-term portfolio holders faced immediate losses despite potential future benefits from price normalization. Portfolio positioning. Investors need to evaluate their technology sector, weighting, and semiconductor exposure relative to their risk tolerance. Those with concentrated positions in chip stocks faced significant portfolio stress from this single-day decline. Diversification lesson. This event reinforces the importance of maintaining diversified portfolios across different sectors and asset classes. Overconcentration in technology stocks amplified losses for many investors during this particular market correction. Forward guidance scrutiny. Management teams will face intense scrutiny regarding their forward guidance and revenue projections in upcoming earnings calls. Investors are now demanding more conservative estimates and realistic timelines for demand recovery. Recovery timeline uncertainty. Analysts are divided on how quickly the semiconductor sector can recover from this valuation reset. Consensus timelines for return to profitability growth have been pushed out by several quarters. Opportunity assessment. This decline presents a potential entry point for long-term investors with conviction in semiconductor fundamentals. However, investors should carefully distinguish between temporary volatility and genuine structural headwinds facing the industry. Risk management. Implementing stop-loss orders and rebalancing strategies helps protect portfolios from further semiconductor-driven losses. Disciplined risk management becomes essential during periods of sector-specific volatility. Final takeaway. While $138 billion in losses sounds devastating, it's crucial to maintain perspective and focus on long-term investment strategies. Understanding the drivers behind this decline helps investors make informed decisions about their semiconductor exposure going forward.